Imagine waking up the morning after a disaster and discovering your regulator sided with insurers instead. The feeling is not merely bureaucratic confusion. It is a deep personal betrayal that costs people homes, savings, and stability. This is the sharp, human edge of regulatory capture where oversight fails those it promised to protect. In this video, we will follow the threads of influence that pull regulators toward industry interests. Our journey will explore history, mechanisms, impacts, and the reforms that might still rescue regulation from corporate grip. Regulatory capture is not an accident or random failure of a system that once worked perfectly. It is a predictable outcome when powerful incentives, concentrated resources, and regulatory weaknesses converge and reshape institutions over time. Understanding that predictability is the first step toward effective reform and public accountability. We will unpack the terms slowly and clearly so viewers can see the mechanisms at work. This explanation will combine history, economics, and psychology to reveal how capture becomes baked into policy-making processes. Historically, insurance regulation developed at the state level with an intention to protect local consumers and markets. Over decades, however, the industry organized through trade associations and model law groups to shape regulations to their advantage. What began as local oversight often ended as a dance between regulators and regulated companies. With industry increasingly writing the rules they would later obey, the National Association of Insurance Commissioners and similar organizations started as cooperative forums, but became channels for coordinated industry influence. When the same actors draft laws, lobby for them, and later profit from them, the line between public interest and private gain blurs dangerously. One of the most corrosive forces is the revolving door where regulators later become executives or consultants for the industry they once oversaw. This movement creates incentives for leniency and a culture where future employment prospects influence current decisions. When career paths align with industry interests, regulatory zeal fades into cautious cooperation. The revolving door also normalizes shared networks and mutual favors that are hard to quantify but easy to observe in decision outcomes, even without direct corruption. These career incentives warp priorities and weaken the consumer protections regulators are supposed to enforce. Lobbying is another engine that drives regulatory capture, fueled by concentrated industry resources and targeted influence campaigns. Insurers spend heavily on lobbying and political donations to shape both legislation and enforcement priorities. These financial flows steer attention away from hard consumer protections and toward regulatory frameworks that favor corporate flexibility. Lobbyists also bring technical expertise which regulators rely upon, but that expertise often arrives packaged with self-interested policy solutions. When regulators rely more on industry, supplied analysis than independent evaluation, oversight tilts toward industry perspectives instead of consumer welfare. Model laws and industry-created standards act as quiet architects of policy across state lines and national boundaries. Organizations draft template regulations that become attractive to legislators because they simplify complex issues. The problem arises when those templates reflect industry priorities more than consumer protections, thereby exporting favorable rules widely and efficiently. This method is subtle, legal, and deeply effective because it appears cooperative rather than coercive. Consumers rarely see the original drafts, but they feel the consequences when coverage shrinks and oversight softens in multiple jurisdictions at once. Regulatory capture reshapes enforcement through budgetary and political pressures that strip agencies of teeth and resources. Agencies dependent on industry, favorable funding, or political goodwill cannot pursue aggressive investigations without risking their budgets. Underfunding is therefore not an accident. It becomes a strategy that limits accountability and empowers regulated firms. When enforcement is weak, bad actors operate with confidence and consumers suffer the consequences in delayed claims, poor underwriting standards, and fewer remedies. The lack of visible enforcement also erodes public trust, making future reform harder to mobilize. The impact of capture on consumers is both immediate and long-term, affecting wallets and life plans alike. Consumers face higher premiums, reduced coverage options, and a system that prioritizes speed of denial over careful adjudication. These are not abstract harms, they translate into foreclosed homes, medical bills, and lives put on hold. Beyond immediate losses, capture distorts the incentives that should drive innovation in insurance toward consumer benefit. When risk is mispriced and competition is constrained by cozy regulation, the market fails to deliver resilience when it is most needed. Natural disasters provide stark examples of capture's human cost when insurers and regulators prioritize profit over recovery. After major storms, policy language and claims handling determine whether families rebuild or collapse financially. In many cases, Lenient enforcement and ambiguous regulation create loopholes insurers exploit to deny or underpay claims. This game of legal chess often unfolds behind closed doors, with regulators slow to act or inclined to accept insurer explanations. The result is public outcry and a perception that regulators are standing with corporations instead of communities in crisis. Health insurance is another terrain where capture can have life or death consequences because coverage decisions directly affect medical care. Prior authorizations, benefit design, and network limitations are all shaped by regulatory frameworks that sometimes favor cost containment over patient access. When regulators adopt industry-friendly rules, they risk creating barriers that prevent timely, essential treatment for patients in need. The complexity of modern healthcare policy makes independent oversight essential. Yet the same complexity is exploited to hide practices that harm consumers. Transparency and patient-centered standards must return to the center of health insurance regulation if capture is to be reversed. Regulatory responses to capture have varied between symbolic fixes and earnest attempts at change, with mixed results. Some governments have introduced waiting periods, cooling off rules, and disclosure requirements to limit the revolving door. These measures can help but frequently fail without independent enforcement and sufficient resourcing to make them effective. True reform requires structural changes rather than cosmetic patches, because industries can adapt to new rules if incentives remain misaligned. This means redesigning financing, transparency, and accountability mechanisms to align regulatory behavior with public interest at scale. One promising reform is independent funding for regulators to remove budgetary leverage from regulated industries. If agencies no longer depend on fees or political favors tied to industry goodwill, they can pursue investigations without fear of retribution. Creating budgetary independence, therefore, addresses a root cause of regulatory timidity rather than treating its symptoms. However, independent funding is not a panacea and must be paired with robust transparency, ethical rules, and public oversight. Funding must be coupled with performance metrics that prioritize consumer outcomes over administrative convenience. Another structural reform is creating independent adjudication mechanisms that sit outside agency influence for dispute resolution. Independent claims tribunals or ombudsman offices with real authority can bypass captured enforcement channels. These institutions offer consumers a faster, more impartial path to justice when insurers deny legitimate claims. For these mechanisms to succeed, they must be transparent, well-resourced, and empowered to issue binding decisions. Otherwise, they risk becoming another facade that placates public anger while leaving systemic incentives unchanged. Transparency is also a powerful tool for countering capture because sunlight makes corrupting influence harder to hide. Requiring publication of meetings, drafts, and communications between regulators and industry increases public scrutiny when citizens, journalists, and watchdogs can follow the paper trail. It becomes more difficult for cozy deals to remain secret. Yet transparency must be meaningful and accessible rather than buried in legalese or paywalled databases. Real transparency empowers consumers and civil society to hold regulators and industry accountable for decisions affecting public welfare. Independent expertise must complement transparency because complex technical arguments often decide regulatory outcomes. Regulators need access to unbiased actuarial analysis, academic research, and consumer impact studies. Funding neutral centers of excellence or academic partnerships can level the technical playing field against industry lobbyists with proprietary models. These neutral sources should be publicly accessible so that everyone can evaluate the evidence behind policy choices. When regulators ground decisions in open, peer-reviewed analysis, capture finds fewer places to hide and less persuasive power. Citizen participation and organized consumer advocacy can tip the balance against capture by turning private grievances into public pressure. When consumers mobilize, attend hearings, and demand accountability, regulators feel their mandate more acutely. Grassroots movements have forced regulatory reversals in the past by making harm visible and politically costly to ignore. Digital tools and social media amplify this effect by making stories viral and connecting dispersed individuals into collective campaigns. An informed, organized public becomes an essential check on the private power that tends to capture regulatory structures. Political will matters because reforms face powerful opposition from well-funded industry interests that benefit from the status quo. Electoral accountability, campaign finance reform, and clearer conflict of interest rules are all part of the solution set. Without political courage, even the best designed reforms will be watered down or blocked entirely. This is why regulatory reform is ultimately a democratic project requiring sustained engagement from voters, journalists, and civic institutions. When politics aligns with consumer protection, The institutional incentives shift, and capture becomes harder to maintain. Technology will reshape how regulation operates, offering both solutions and new risks that require careful governance. Big data and AI can detect patterns of bad actor behavior faster than human auditors can. However, those same tools can be used by insurers to refine exclusionary underwriting or to automate claim denials without human oversight. The task for policymakers is to harness technology for transparency and fairness while preventing its misuse for exclusionary practices. That balancing act requires forward-looking regulation that understands both the promise and perils of new tools. International cooperation can reduce regulatory arbitrage by aligning standards across borders and closing loopholes companies exploit internationally. Insurers operating globally can play jurisdictions against one another to find the most favorable rules. International agreements and cross-border oversight bodies can reduce that competition and set minimum consumer protection floors globally. Such cooperation is challenging politically, but increasingly necessary as markets integrate and risks become globalized. When regulation remains fragmented, companies will continue to migrate to permissive environments, and consumers will bear the cost. Metrics and accountability frameworks should reward consumer outcomes rather than mere compliance checklists that impress industry lawyers. Regulators should report on consumer satisfaction, claim resolution times, and the incidence of disputed denials, shifting performance indicators toward real-world outcomes will reorient priorities toward protections instead of paperwork. Public dashboards and independent audits can make those metrics meaningful and resistant to manipulation. When agencies are judged on whether consumers are better off, policy choices naturally favor protection over permissiveness. We must also reconsider the role of private actors in standard setting and give consumers and civil society proportionate influence. Industry expertise is valuable, but it should not dominate policy formation without counterbalances. Formal advisory roles for consumer groups, academics, and independent experts can diversify inputs and reduce capture risks. Institutionalizing these counterweights makes regulatory processes less vulnerable to single-interest domination and strengthens legitimacy. Diverse participation creates better decisions and increases public confidence in regulatory institutions. Reform will face resistance, but history shows that institutional change is possible when crises reveal systemic failures. Public scandals and catastrophic events have occasionally forced reforms that strengthen consumer protections. Those moments must be seized with structural changes rather than symbolic gestures if capture is to be confronted seriously. Policy windows open and close quickly, so preparedness, organization, and clear reform proposals are essential. Citizens and advocates who have a plan ready maximize the chance the crisis leads to durable improvement rather than temporary outrage. What does a future with less capture look like for everyday people? It means fairer claims processes, predictable and transparent coverage, and regulators that proactively enforce standards. It means rebuilding trust between citizens and institutions so that insurance functions as social infrastructure in moments of need rather than as a source of uncertainty. This future requires work from regulators, civil society, and consumers alike, but it is achievable with the right incentives and commitments. Public interest regulation would restore insurance to its social purpose instead of letting it become merely a private profit engine. Consumers themselves are not powerless and play a crucial role in reshaping regulatory dynamics over time. Collective action through class actions, advocacy groups, and watchdog organizations creates leverage that individuals acting alone lack. When consumers organize and shine light on abuses, the political calculus of regulators and legislators shifts quickly. Education and transparency empower consumers to make better choices and to hold both insurers and regulators accountable. Democratic engagement remains the single most powerful antidote to capture if citizens choose to exercise it deliberately. The philosophical twist is that regulation is not merely technical machinery, but a reflection of civic values and priorities. When a society prizes private profit above communal resilience, capture becomes predictable and enforcement weak. Conversely, when democratic legitimacy and public welfare drive policy design, regulation can serve as a tool of collective insurance and social stability. Thus, the battle against capture is also a political and moral struggle about what we value together. If you care about fairness, stability, and dignity in times of crisis, then regulatory design becomes one of the most consequential debates of our time. To close, regulatory capture in insurance is not inevitable and is not permanent if citizens demand better structures. Practical reforms like independent funding, adjudication, transparency, and inclusive governance can make a real difference. The challenge is political, technical, and civic, but the rewards are social resilience and restored trust. If this gave you a new perspective on how power shapes the rules that govern risk, consider sharing this video with others. If you want more explorations into the intersection of policy, economics, and everyday life, hit subscribe and join the conversation.